we'll discuss markets and macros with a very special guest joining us today. She's joining our network for the first time today, all the way from Singapore. I'm talking about Charu Chanana. She's the macro and market strategist at Saxo Bank, and she joins us from Singapore today. Good morning, Charu. Thanks very much for your time.
Hi, Ajay. Pleasure.
When we speak to strategists all across the world, one thing which is almost a unanimous call right now is that risk on is not warranted. It's not justified. And people are raising their hedges also. We've seen that data, right? $6 billion worth of hedges or puts were bought last week by global fund managers. But market is not obliging with a big crash. Market continues to be resilient, equities globally as well as emerging market like India. How do you see this? Genuine macro worries on the one hand, but relative resilience of asset prices.
That's a great question, Ajay. And, since I am a macro strategist, I will start there. And of course, like you said, there are lots of macro worries on the ground. We have global central banks who are in a tightening race mostly. The Fed is raising rates, doing quantitative tightening. ECB last night did a 75 basis points rate hike, but at the same time also guided for more rate hikes to come. All this, and along with that, we have a brewing energy crisis. So there's been massive underinvestment in the energy space, and it's not just driven by Russia. Of course, that has aggravated the situation, but and at Saxo, we believe that energy crisis will likely continue to linger for a very long time. So all of that, does of course point towards more pain to come in the equity markets. But at the same time, now central banks are, a lot more cautious of market volatility, of market downturns. And what we've seen, previously from the Fed particularly, which obviously drives global asset prices in some way or the other, is that even though they go for massive rate hikes and massive, tightening in the quantitative side as well, it sometimes gets, it comes along with a little bit of a softer tone, and that obviously results in these bear market rallies. So overall, we still think that there will be more pain to come in the equity markets, but it's not going to be like a big crash. There's going to be some sideways movement. Right now, for example, we are seeing some positioning adjustment ahead of a US CPI release, which is on next Tuesday. So I think that will continue. You will continue to see these bear market rallies more and more so in this downturn, but overall trend in the markets will still likely remain down.
Right. Charu, the other point is that whenever there's a big macro worry, or even when the Ukraine war broke out, a geopolitical worry, or even when China, Taiwan come to loggerheads, start staring each other in the eye, one phenomena which is being observed is that bullion, which is precious metals, are really not getting impacted. This is not actually a question to understand where gold, for example, actually moving. That's not my agenda or objective. I want to understand where is the risk premium now going. There is macro worry, there are warlike situations also, but still, safe haven, only dollar is the one which is rising, nothing else.
Absolutely. I was going to come to that. Right now, the Japanese yen has also kind of lost its safe haven status, because it's not one factor or the other. There's a multitude of, factors playing at the same time. When you talk about gold, particularly, even though we are seeing rising geopolitical tensions with Russia, Ukraine, with China, Taiwan, with US, China, but that's not it. At the same time, you have a rising dollar and higher US yields, which obviously kind of, weigh down on the value of gold. So, considering so many risk factors at the same time, it is certainly hard to find some good investment opportunities in the markets at this time. But I think it's important to have your time horizon in mind. And if you are a long-term investor, I'm pretty sure you can keep that in mind and still find some interesting opportunities out there.
Charu, your thoughts on commodities, looking at the the worries on growth, looking at the worries on large engines of global growth, China and US, and now increasingly Europe also under pressure. Asia, though, is relatively better off, markets like India. What does it hold for commodities, this kind of environment?
Yeah. So, commodities are also finding it hard to balance out the demand and supply concerns in this environment. But at Saxo, we are quite overweight commodities. We have been since November last year. And I think that has played out really well and still has potential to run. I mean, of late, I think the focus has shifted a little bit more towards the demand worries, where, of course, you talk about China's continued zero COVID policies, as well as, fears of recession in rest of the world. But I mean, if you look at it, the US economic data is actually still holding up pretty strongly. I mean, ISM services last week and, many of the other data points have actually continued to point at resilience in the US economy. Certainly, stagflation risks are bigger for European economies, and that also plays in. And in terms of China, I mean, they cannot persistently, obviously, stick with that zero COVID policy. So, I mean, personally, I do think that there is some potential, end that you can visualize in the demand situation, whereas the supply situation from my side is a bigger concern. There has been years of underinvestment in the energy space, in the commodity space in general, and now you have these structural trends where you have deglobalization, you have climate change, which is impacting agricultural outputs, and these are likely to continue. So once we shift the focus back to fundamentals away from speculative trading, the supply side concerns will take over. And I think that obviously means that commodity prices will still likely go higher from here.
Abhishek, what's your broad hypothesis then for 6 to 12 month kind of a view?
I think, like I hinted at it earlier, I think broadly, I think the global markets are still going down. But if you really want to find opportunities, there could be some interesting opportunities in the commodity space if you weigh out these demand supply concerns. But also at the same time, you could find some interesting opportunities in defense because, of course, these geopolitical issues and these general deglobalization factors have increased the need for defense spending, more so in Europe, but I think also globally. If I look closer to home in emerging markets, of course, there are some very interesting opportunities, I think, in India, of course, in Indonesia and in Vietnam as well.
Do you think Indian outperformance, which we have been seeing in the short term as well as the long term full year, YTD India has massively outperformed larger markets, and many strategists saying that this premium which India is commanding over EM is justified because of superior earnings quality. This may continue for some more time?
Absolutely. I mean, long term, of course, you have the demographic story playing out really well, which obviously kind of suggests that this is the decade for India. And, there is the rapid urbanization taking place, rapid digitization taking place, there's a growing middle class. So all of these trends are, of course, the structural forces behind India's performance, and tactically as well, because of, investments moving out of China, because of regulation risks, because of zero COVID policies in China. A lot of these portfolio funds have been diverted to India. I think the key thing to watch will be India's inclusion in global bond market indices. If that happens, I think there will be a lot more inflows into the Indian markets as well. And but if that falls through, we could see some temporary setback. But in the long run, I think I would still be bullish on the Indian markets because of their structural, the tailwinds that we are seeing there.
All right, Charu, thanks so much for your time. Good having you on the channel. Thanks for taking out time for our discussion today.